Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know first, a $3 trillion AI data center boom pushes engineering to Apollo program levels, sparking a race for power, water, and private grids. This discussion will reveal how this infrastructure race creates geopolitical risks of digital colonies and what it means for global energy markets. Second, Zerohash hits a $1 billion valuation with a $104 million investment from Morgan Stanley and other Wall Street titans. We'll analyze why this invest-to-own-the-stack strategy is a turning point and how it could accelerate crypto adoption in mainstream finance. Third, Amazon FTC lawsuit reveals executives called Prime's shady cancellation process, the Iliad, designed to trap millions of customers. We'll analyze why holding individual executives liable is a turning point and how it could affect product design ethics across Silicon Valley. Fourth, Chinese EV giant BYD confirms a backup plan to ditch Nvidia chips, challenging the US firm's dominance in the auto market. Today, we'll take a closer look at Nvidia's CUDA software moat and its implications for the emerging AI splinternet in the auto industry. Fifth, Porsche slashes profit forecast to 2% and slows its EV rollout, blaming intense price pressure from Chinese competitors. We'll explore how this strategic retreat toward combustion engines and e-fuels could transform the luxury auto market's race to electrification. The story begins with a number that's almost hard to comprehend. $3 trillion, that's a figure so big, it's roughly the entire economy of France, and it's all about to be spent on a new kind of factory. These aren't just any factories. They're AI data centers, and they're being built at a furious pace. The UK alone is estimated to need another 100 in just the next few years to meet demand. So what makes them so expensive? It's all about density. Most AI relies on pricey Nvidia chips packed into cabinets costing around $4 million each. To make the AI work, these cabinets have to be jammed together because every single meter of distance between chips adds a nanosecond of processing delay. It sounds small, but across a warehouse, it kills performance. And as we discussed a while back, it's not just stacking GPUs, it's the ultra-low latency fabric stitching them together. Think RDMA style networking, the kind that's given certain clouds a real performance edge. So the real impact here isn't just about money, it's about a new kind of geopolitics. This need for physical closeness is creating a power imbalance. You see, AI compute power isn't spread evenly around the world. A study from the University of Oxford found that these crucial data centers are located in only 33 countries, with the vast majority in the US, China, and Europe. Think about that. In all of South America, only Brazil has this kind of public cloud AI capability. In Africa, only South Africa. This creates a huge risk that countries without their own high-density data centers could become what some are calling digital colonies, completely dependent on the nations that control the physical hardware of intelligence. And a while back, we noted how even the biggest players, Microsoft and Google, have been offloading massive AI capacity to Oracle. Not organic wins, but a tell that usable capacity and interconnect live in very specific places. That concentration is the point. This creates an engineering problem so extreme. One expert compared it to the Apollo program. And that's where the challenge becomes almost overwhelming. The problem isn't just power, it's heat. A single top-of-the-line AI chip like an Nvidia H100 can consume up to 700 watts of power and generate an incredible amount of heat in a tiny area. Traditional air cooling, the kind we've used for decades, simply cannot keep up. We're now seeing the widespread adoption of advanced liquid cooling, including direct-to-chip systems and even full immersion, where entire server racks are submerged in a special non-conductive fluid. This is what the Apollo program comparison really means. We are pushing the absolute limits of thermal physics. These facilities consume gigawatts of power, and their demand on the grid isn't steady. It spikes unpredictably, described as being like thousands of homes switching their kettles on and off all at once, every few seconds. As we mentioned a while back when we talked about AI loads rivaling whole towns and demand set to more than double by 2030, the new wrinkle here is volatility and locality. It's not just how much energy, it's where and when. The solutions are getting radical. Nvidia CEO Jensen Huang recently suggested building more gas turbines off the grid to avoid burdening the public. Meanwhile, Microsoft is investing in a deal to use nuclear power from 3 Mile Island, and Google is also investing in nuclear to meet its energy goals. Continuing our last discussion about grid capacity, this is the logical next step. If the public grid can't keep up, hyperscalers build around it. Now, get this. When these tech giants talk about going off-grid, they're not just unplugging. They are effectively building their own private parallel energy infrastructure. This move towards what some are calling a sovereign grid raises huge questions. What happens to public utilities when their biggest, most demanding customers leave? It could fundamentally change our energy markets, and we are only just beginning to grapple with the consequences. And it also explains why, in the meantime, some workloads are shifting to whoever already has the racks, the fabric, and the power. Think back to that Oracle as power broker dynamic we flagged. But that's not the whole picture. It's not just about power. It's also about water. We haven't spent much time on this before, and today it's front and center. And the numbers here are staggering. Research from the University of California, Riverside, found that just training one AI model, GP3, was estimated to have consumed 700,000 litres of fresh water. That's nearly 200,000 gallons. Microsoft's own report show its global water consumption jumped by 34% in a single year, largely due to its AI research. This isn't a side issue. Water scarcity could become the ultimate bottleneck for AI's growth. In the UK, a proposed AI site has already run into objections from Anglian Water, which pointed out it's not obligated to supply drinking water for non-domestic use. This has led some in the industry to coin a new term, braggawatts, for how companies are talking up their projects. One tech investment advisor admits the current trajectory is very difficult to believe. That skepticism echoes the caution we shared when we talked about capacity musical chairs and behind-the-scenes power brokers. But while some see a bubble, others see the real estate of the tech world. Unlike past tech booms that were purely speculative, these AI data centers are very solid bricks and mortar assets. But here's the critical question we have to ask. Alibaba's chairman, Joe Tsai, has warned that this feels like an indiscriminate rush, with companies building data centers without even having clear customers lined up. It brings back memories of the dot-com bubble when companies overbuilt fiber optic networks that sat empty for years. So if this AI gold rush slows down, can you even repurpose a hyper-specialized, liquid-cooled, gigawatt-scale AI facility? Or will we be left with the world's most expensive and most empty warehouses? The spending boom behind them, however, cannot last forever. And as we've been tracking, whether a few players become the permanent power brokers or just temporary landlords may come down to who solves the power and water bottlenecks first. We were just talking about the race to build the physical infrastructure for AI. Now, let's shift our focus to the financial infrastructure being built for crypto. Some of the biggest names on Wall Street just made a massive bet on it. Crypto infrastructure startup Zerohash just pulled in a stunning $104 million in a new funding round, rocketing its valuation to a clean $1 billion. But the real bombshell is who's writing the checks. We're talking about financial giants like Interactive Brokers, Morgan Stanley, SoFi, and even funds managed by Apollo. Now, $1 billion for a crypto infrastructure company might sound steep, but so the thing is, for a giant firm like Morgan Stanley, building its own crypto technology from scratch is a massive headache. We're talking about a process that can take 18 to 24 months and cost upwards of $25 million just to get started, with millions more in annual upkeep. It's slow, it's expensive, and it's incredibly complex. So instead of building, they're paying Zerohash to handle all the complex plumbing, the security, the regulatory compliance, the 24/7 trading so they can plug right into the crypto market. That's why Zerohash is worth $1 billion. It's selling speed and simplicity to the biggest players in finance. This signals a seismic shift in the financial world. The move comes as the industry takes advantage of a more favorable regulatory environment for cryptocurrencies under President Donald Trump. This shift is happening because we're seeing specific concrete regulatory changes. For instance, the administration recently rescinded a rule known as SAB 121. And here's a detail that's crucial to understanding this shift. That old rule basically forced banks to hold huge amounts of capital if they wanted to custody crypto for their clients, making it almost impossible for them to get involved. With that barrier gone, the floodgates are starting to open. This creates a regulatory environment that doesn't just permit, but actually encourages these huge institutions to invest in digital assets to stay competitive. It's a complete 180 from the government being highly skeptical of crypto under the former Securities and Exchange Commission chairman. Now, CEOs of major firms are publicly expressing confidence that they will get involved. If that was just the appetizer, the main course is just being served. Interactive Brokers already uses Zerohash for crypto trading and plans to launch a stablecoin product with the firm. And a brokerage firm creating its own stablecoin, that's actually a huge deal. Instead of using an existing one, creating their own gives them total control. Imagine being able to fund your brokerage account instantly, 24/7, without waiting for the old banking system to open on Monday morning. That's the goal. It allows them to bypass traditional payment rails, create new revenue streams, and offer a service that their digitally native customers are demanding. However, if you zoom out, you'll see another layer of strategy at play. When asked if behemoths like Morgan Stanley and SoFi were also clients, Zerohash founder and CEO Edward Woodford gave a statement that suggests something big is on the horizon. He said, "These groups aren't VCs." You can assume that there's obviously a couple of announcements coming down the road with these other investors. What he's really saying when he claims they aren't VCs is that these are strategic partners. They aren't just betting on Zerohash to make money. They're investing to use the technology themselves. This is a strategy called invest to own the stack, where instead of competing with a fintech company, a big bank co-ops it, integrating its technology directly. This is a sign that the future of finance is collaboration, not competition. The message is clear. Wall Street isn't just dipping its toes in crypto anymore. It's preparing to dive in, and the biggest players are getting ready to make their move. Speaking of major corporations and their strategic plays, Amazon is now in the hot seat for a strategy that's being called outright deceptive. An explosive internal email has just been revealed where a top Amazon executive called the company's subscription tactics shady and referred to founder Jeff Bezos as the chief dark arts officer. This is the centerpiece of a massive federal trial where the Federal Trade Commission is accusing Amazon of systematically deceiving tens of millions of customers into its Prime program. The FTC alleges Amazon used so-called dark patterns, deceptive design tactics meant to trick users into signing up. What's being alleged here is a classic example of a Roach Motel design, a well-known and shady playbook in the tech industry. It's incredibly easy to check in, but almost impossible to check out. The goal is to trap users into a subscription, often without them even fully realizing it. And according to regulators, Amazon knew about the problem for years. Damning internal documents describe the issue of accidental enrollments as an unspoken cancer festering inside the company because fixing it would hurt subscriber numbers. But trapping customers was only half the battle. The FTC alleges Amazon then deliberately sabotaged their attempts to cancel. The cancellation process was so intentionally confusing, requiring users to navigate 4 web pages and 15 different options, that Amazon employees gave it a secret code name, Iliad, a direct reference to the epic, complex poem about the Trojan War. They internally described it as a labyrinthian mechanism. And this isn't just an Amazon problem. Believe it or not, it's everywhere. A recent FTC study from 2024 looked at over 600 subscription services and found that a staggering 76% of them used at least one dark pattern to keep customers locked in. So while Amazon's Iliad is an extreme example, it's part of a much wider industry issue. The stakes here are enormous. Prime is one of the world's most popular subscriptions, with over 200 million members generating billions for Amazon. This is the same program Jeff Bezos famously said should be such a good value, you'd be irresponsible not to be a member. But here's the paradox that this lawsuit blows wide open. If Prime's value is so undeniable, why the need for a convoluted cancellation maze like the Iliad? The FTC's argument suggests that this reliance on dark patterns is proof that Amazon may be worried the standalone value of Prime isn't as strong as it publicly claims, and that it needs to trap users to maintain those massive subscriber numbers. Amazon maintains its processes are clear and simple, and that occasional customer frustration is inevitable. However, the FTC has already notched an early win. A federal judge has ruled that 2 senior Amazon executives can be held individually liable if a jury sides with the government, putting their personal careers on the line. The individual liability aspect is a crucial detail here because the FTC is signaling a major shift in how Silicon Valley is regulated. we're seeing a trend where the government is no longer just finding the company. They're going after the individual executives who make the decisions. This has happened with leaders at Adobe over hidden fees and even the CEO of Drizzly over data security failures. The message is clear. Leaders can no longer hide behind the corporate logo. They will be held personally accountable for the ethical consequences of their product designs. This trial now forces a showdown between Amazon's carefully crafted public image of customer obsession and its own explosive internal communications, with the future of its multi-billion-dollar subscription empire hanging in the balance. From one American tech giant under fire to another making bold threats, our next story shifts to the US-China tech rivalry. China's electric car giant, BYD, just went on the record with a bombshell statement about its relationship with US chipmaker Nvidia. A top executive has confirmed that BYD has a backup plan if it gets cut off from the American chips it currently uses in its cars. A while back, we talked about Nvidia's surprising $5 billion tie-up with Intel to spread its manufacturing risk beyond TSMC today. The spotlight shifts to the customer side of that same geopolitical chessboard, one of Nvidia's biggest auto partners in China signaling its hedging too. This backup plan is more than just a corporate talking point. It's a key part of China's national strategy for semiconductor self-reliance. Interestingly enough, the backup doesn't necessarily have to be as powerful as Nvidia's best chips. Research shows that for the mass market, what really matters are the safety and convenience features like adaptive cruise control and lane keeping assistance. These are called level 2 systems, and they don't require the absolute most powerful chip on the planet. So a good enough domestic chip from a company like Horizon Robotics could be a perfectly viable backup for the features most drivers actually use. The executive vice president, Stella Lee, didn't mince words, telling reporters, everybody has a backup, BYD has a backup. The real challenge here isn't the hardware though, it's the software. Switching chips isn't like swapping a battery, it's a massive software challenge. Most of the world's autonomous driving software, including what's in many BYD cars, is built on Nvidia's exclusive platform called CUDA. Think of it as the operating system for AI. To move to a new chip, BYD would have to completely rewrite and revalidate its entire software stack. This is a monumentally difficult and expensive task, which is why Nvidia's software is often called its moat. It keeps customers locked in. We previously analysed how Chinese regulators zeroed in on that exact lock-in and how Huawei has been pushing its CANN stack as an escape hatch. BYD's backup, whatever silicon it chooses, still has to cross that same software canyon. This statement lands directly in the middle of the escalating tech rivalry between the US and China, where Nvidia has repeatedly been a central figure. Remember our discussion about an emerging AI splinternet? This is what it looks like at the steering wheel level, redundant stacks forming on both sides to reduce single points of failure. So it's crucial to understand what kind of chips we're actually talking about. The ones the US has restricted are the ultra-high performance data center chips, like the H100, which are used to train massive AI models and have clear national security implications. The automotive chips that BYD uses, like the Drive Orin, are different. They are designed with extreme safety and reliability standards, known as ASILD, and use far less power. So far, they haven't been seen as the same kind of security risk, which is why they haven't been restricted. The fight is over the AI training chips, not necessarily the chips that run your car's cruise control. And as we noted a while back, Nvidia's center of gravity and its supply chain hedging with Intel remains squarely around those data center parts, not automotive. To back up the claim, Lee pointed to the last major supply crisis, the global semiconductor shortage. She noted that while the auto sector was crippled, BYD had no issue because of its massive investment in in-house technology. The company has famously sought to control its own destiny by manufacturing everything from its own batteries to its own car components. Lee then delivered a quote that puts the entire situation into sharp focus, issuing a stark warning about the consequences of a potential ban. She said, "I don't think any country will do that because this automatic will kill Nvidia." She went on to say that if Nvidia, currently the highest market value company, were to lose the big market from China, nobody wants to see this. This is a powerful threat, but a closer look at the numbers suggests it might be a bit of a bluff. Recent financial reports show that Nvidia's entire automotive division only makes up about 1.5% of its total revenue. The vast majority of its money comes from those high-powered data center AI chips. That tracks with what we discussed before. Nvidia's dominance rests on CUDA and the data center GPU stack, not the car business. This is more than just a contingency plan. It's a declaration of independence and a powerful strategic message. In the high-stakes battle for tech supremacy, BYD is signaling that it's not just a customer playing defense. It's a global heavyweight, confident in its ability to survive a cutoff, and openly questioning whether one of America's most valuable companies could survive losing them. And if the parallel non-Western AI stack we've been tracking keeps hardening, expect more moves like this on both sides to make that AI splinternet feel a lot less theoretical and a lot more real on the road. Speaking of Chinese EV giants like BYD, their competitive pressure is being felt all the way over in Germany. European luxury icon Porsche just dropped an absolute bombshell in their latest report. The company slashed its projected profit margin from as high as 7% all the way down to 2% or less. The market reaction was immediate. Porsche's stock plunged over 7%, and its parent company Volkswagen fell right along with it. A while back, we talked about Chinese EV makers crashing Europe's party with bombshell targets and a full A-stack push into the region. Today's sell-off is one more sign that pressure isn't theoretical anymore. It's hitting Europe's luxury flagships in real time. The reason for the freefall is a major reality check for the entire luxury car industry. The situation presents a fascinating duality. On one side, there's weakening demand, while on the other, it exposes massive engineering hurdles. You know, it's not just about sales numbers. Electrifying a heavy, high-performance SUV without losing that signature Porsche feel is incredibly difficult. The weight of the batteries can ruin the handling. To solve this, Porsche has been developing an amazing system called Porsche Active Ride. It uses electrically powered hydraulic pumps at each wheel, adjusting up to 13 times a second to counteract the body roll from the battery weight. It's a brilliant solution, but it's also complex and expensive, hinting at the real cost of going electric without compromise. And as we noted a while back, China's tech-first players iterate new models in 18 to 24 months and ship features like their software updates. Porsche's choice to engineer around physics with ultra-complex hardware preserves the brand's feel, but it's slower and costlier to scale. In a stunning strategic reversal, the company announced that an upcoming line of sport utility vehicles, originally planned as fully electric, will now launch exclusively with combustion engines and plug-in hybrid options. This isn't just a minor course correction. Porsche is extending production of its classic combustion engine models. That means iconic cars like the four-door Panamera and the Cayenne will continue to be sold with non-electric options well into the 2030s, even as the European market faces a 2035 deadline to ban new gas and diesel cars. This is where their strategy gets really interesting because it isn't just a retreat. It might be a calculated gamble. Porsche's invested over $100 million into something called synthetic e-fuels. These are nearly carbon neutral fuels made using renewable energy. And here's the kicker. The EU's 2035 ban has a potential exemption for cars that run exclusively on these e-fuels. So Porsche isn't just delaying EVS. They're actively building a potential escape hatch to keep their legendary combustion engines alive. So what's forcing this retreat? Fierce competition from Chinese brands like BYD and Xpeng, who are caught in a price war that has seen average car prices in China drop an estimated 19% in just 2 years. We previously analysed how price and technology are the twin blades of that strategy, and now the price war is cutting straight into Porsche's biggest market. And the impact on Porsche's biggest market, China, is undeniable. While Porsche's global sales were actually up, their sales in China, their largest market, fell by 12%. Meanwhile, a Chinese competitor, BYD's Yangwang, launched a luxury SUV that sold 5,000 units in just over 4 months. That's the fastest any vehicle in that price class has ever sold in China. This isn't just competition. It's a fundamental market shift. And remember, this isn't just a few flashy models. We talked about Chinese automakers setting aggressive European targets like GAC's plan to jump from roughly 3,000 cars to at least 50,000 by 2027, backed by control over much of the battery supply, chain, and even component plants in places like Morocco. That industrial depth is what allows lower prices while still shipping software-rich cars. Other European giants like BMW and Mercedes-Benz are also feeling the heat, slashing costs to stay competitive. A while back, we noted how Chinese brands nearly doubled their market share in Europe as Tesla's sales softened in the region. Today's cost-cutting is the clearest sign the incumbents are playing defense. We're seeing Porsche take this path, while at the same time, Ferrari is taking a completely different one. charging ahead to unveil its first all-electric supercar in 2025. This shows a real split in strategy at the very top of the automotive world. This all points to a dramatic pivot and leaves Porsche facing a true brand identity paradox. Remember, their all-electric Taycan actually outsold the legendary 911 in 2021, proving their customers are ready for electric. By slowing down, they protect their heritage, but they risk being seen as a laggard and losing the next generation of buyers to competitors who are all in on the electric future. And as we've discussed before, the premium EV fight is increasingly about software cadence. By tapping the brakes now, Porsche preserves its driving DNA, but risks being outpaced by rivals that treat the car as a software platform and iterate at smartphone speed.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.